last class we had discussed about the investment norms of the commercial banks, right? We discussed about three basic aspects: liquidity, safety, and profitability. Here up, next topic is liquidity of commercial banks. So in detail, we're going to study about the liquidity norms of commercial banks. What is liquidity? As we all know, it means nearness to cash or easy convertibility to cash. That means an asset quickly transferred into a currency within no time. Concept of liquidity. In what terms should a bank focus on liquidity is in two terms. One is deposit liquidity and second is loan liquidity. The deposit liquidity is, it means the ability of a banker to meet the demand of his depositors for cash as and when they arise. As I told, your all the four types of accounts, savings, current, FD, RD, all these are called deposits, correct? Especially focusing on FD and RD. Anytime if there is an emergency, people can come and demand for the pre-closure of FD or for the pre-closure of RD account. Therefore, bank has to keep in mind the deposit liquidity aspect. Whatever deposits the bank has, right, it has to have a percentage of those deposits ready in the form of liquid. Therefore, in order to meet the emergency requirements of its customers. Second part, loan liquidity or loan ability. It refers to bank's capacity to meet all the credit requirements of its customers. How, as much as bank is focusing on returning the deposits whenever the customers demand for it, on the same way the other side is loan, because loan is where the banks earn profit by giving credit. So bank also need to maintain enough amount of liquidity in order to meet the credit requirements. Is that clear? In order to meet the credit requirements of the people. It can be any kind of loan, educational, personal or car loan or vehicle loan, any kind of loan. It need to assess the credit requirements and then to keep a good percentage of liquid money enough to meet the customer's requirements. So both in terms of deposit and in terms of loan, the bank has to have a requirement of liquidity of cash. Factors influencing liquidity. One of the three major factors are: first, cash reserve ratio. As we know, last class we just studied, if you remember, bank ratios or bank rates, right? We studied about SLR, CRR, repo, reverse repo, bank rate, all the 5 rates we discussed about, correct? Now there we read SLR is a percentage on total deposits kept with the bank itself. Opposite, what is cash reserve ratio? A percentage of total deposit kept with the Reserve Bank of India, that is central bank. Is that clear? Now in case anytime if you're getting confused to write the difference between SLR and CRR, right? One of the ratio is kept with the bank, one of the ratio is to kept with the RBI. If you're getting confused, SLR is always kept with the bank itself. CRR is the ratio that has to be kept with the central bank. Now in case how to identify, there's just a small trick is that, now here the second ratio is CRR, cash reserve. So in that middle word reserve it says, that means Reserve Bank of India. Okay, that way you can remember that CRR is a percentage kept with the Reserve Bank of India. So the opposite, SLR, is the percentage kept with the bank itself. So one of the factors that affect liquidity is CRR. How much percentage of your total deposits you are keeping with RBI, the rest of the deposits you will have with yourself for the operation of banking activities. Is that clear? How much percentage of your total deposits in the form of CRR you are depositing with RBI? The left out money, that is apart from SLR, the left out money is meant for the business or for the banking activities. Second, banking system. Banking system influences the liquid requirements. Now one more thing that you need to notice here is, where is the bank set up? Is it in the rural area? Is it in a smart city, or is it in a urban area where everything is civilized and developed? Based on which locality the bank is located in or established in, again the liquidity requirements is also going to change, because in rural areas I'm sure there's not going to be much of they're going to be more of liquid cash that they need, right? They don't know to access maybe credit cards or ATMs or Paytm or phone pay, etc. Whereas for urban areas, what do we need? We need more of, we all transact using technology, we transact using applications, correct? More of net banking, etc. So the requirement of money in an urban city is more than the requirement of capital in a rural city. The way you use money might be different. In rural, you might use currencies only. In urban areas, you might use only, you may transact using credit cards, you may transact using debit cards, or you may transact using phone applications such as Phone Pay or Google Pay, etc. Right? So the banking system where it is established, okay, based on that particular locality, what are the what are the incomes and savings of people? What are the savings or spending habits of people? Based on all these, the banking system also plays a important factor in influencing its liquidity position. Number 3, use of check. The use of liquid cash in transactions will reduce. As we know that back then when bank was established or introduced, everything was in the mode of currency. Later when bank introduced the usage of check, especially for business people who are dealing with lakhs or crores of rupees, it is highly risky to deal so much of crores of amount of rupees in terms of liquid cash. So it would be better to transact in terms of what? Check. Check is more secure for a transaction. Of course, now later on we have the electronic transfer, NEFT or RTGS, etc. So all these advancements in the banking system has enabled the bank, instead of keeping liquid cash in the bank, if you just transfer same thing in account, right, it is easy for people to transact. Number 4, nature of business condition. Inflation and depression affect the liquidity position. Now that is, inflation is more money chasing fewer goods. As we I think I've told you or explained to you about the time value of money, right? Back then people were able to run the entire household expenditure maybe with just 50 rupees of their income. That means only one person is the breadwinner of the family. But then today everything is increased. The prices of right from what kitchen essentials that we require or for the luxury items, everything has increased, right? That means the demand with the population, the demand for goods and services, the manufacturing of the same, again the types of goods and services available, again they're different class of goods, right? There's luxury goods, there's goods that are necessity, etc. Based on all these, the inflation and the depression affect the liquidity position, right? So sometimes there may be more money chasing fewer goods, and the other times there is enough amount of goods and services available, but we do not have enough money to buy them or take the service from the manufacturer. Is that clear? Now today, as we see in the news that GDP has fallen, or the finance minister has I think 2 days back it was officially announced that India is going through, the GDP has fallen down for continuously 3 quarters, right? That means the money flow in the economy is reducing. There are enough amount. Is there goods available in the country? Is there services available? Yes, but people do not have enough money to transact or have a business activity or to buy or sell something. Is that clear? So nature of business conditions will also impact the banks. If you can see, as and when this lockdown began, people refused to have any social activity. Only if you go out of your home, right? It can be for a travel, you need money, you will spend money, or if you want to go to a movie, you're going to spend money. Everywhere there is a money involved. But since lockdown, the money movement of money was absolutely nil or absolutely reduced. You got my point? Now therefore, depending on the circumstances we are going through or situations we are going through, even people who are planning to take a loan, maybe right from this beginning of the year, we are almost at the end of the year now, maybe from Feb, March, looking at the situation, looking at the pay scale, job loss, etc., people refused to take a loan. That time, banks did not have any did not have any customers approaching the banks to take up loan. Why? Because they themselves did not have a job, or maybe they even had pay cuts at their employment. So because of all these circumstances also, banks will be affected, okay, in terms of transactions. Number 5, seasonal conditions. Banks have to take into account the seasonal requirements. Festival seasons requirement of cash will be high. As we know, the live example that we had, the festival Deepavali or Diwali or Christmas coming up, etc., people are going to purchase more. The spending habits of people in this last 2 months of November, December will be very high, maybe even at the peak, correct? So likewise, banks have to be ready with their liquid cash at these peak seasons or seasonal requirements. Is that clear? So there are some times where people believe not to have certain transaction or not to buy gold, but there are some times where people are ready to buy gold, people are ready to invest, people are ready to buy certain goods and services. So banks have to understand these seasonal requirements and accordingly plan their liquidity requirements. Number 6, policy of fellow bankers. Fellow bankers maintain high cash reserve to win public confidence. This so often happens, right? If we have to compare from one bank to another bank, so this bank just takes 2 days to encash my check or credit my check into my account, but another bank takes almost 1 week. Have you heard people talking about that? Right? That means the facilities available with the bank on certain terms will differ based on what? The liquidity position or even granting of a loan. One bank will sanction loan within a 1 week, one bank will take another month. Again, it depends upon the amount of loan that you take also, correct? Now, this policy that each and every bank has will differ. Accordingly, what? How much deposits does a bank have? Where is the bank situated? What are the requirements of people around them, etc. So all the policies of each banker, it can be Vijaya Bank or Syndicate Bank, SBI, Canara Bank, each banks will have its own policies, and banks will be getting affected of its fellow bankers policy. If I as a Vijaya Bank have low liquidity position and my fellow banker, that is Canara Bank, is high liquidity position, people automatically will go to Canara Bank rather than visit Vijaya Bank, correct? So that is what here the point talks about, policy of fellow bankers. Profitability of banks. Now we looked at investment, we looked at liquidity, now we are going to look at profitability. As any other business, banks should strike hard to earn maximum profit. Yes or no? As we told, banks earn profits with the margin of income, that the interest they charge on loan and the interest they give on deposits. If they're charging 12% on loan, they might just pay 10% to depositors. The difference of 2% is what the bank earns. For what are the requirements for the bank to meet? Cost of running the bank. It can be the machine or the equipments they use, the lockers they use, the ATM facilities they give, or the labor working over there, right? Or the technology, the computers, all of this is going to take a lot of investment or expense. So we need profits to run what? The cost of running the bank. Second, pay interest on deposits. If there is no source of income for me, how would I pay interest on deposits? It's not possible, correct? So I need to have a source of income for me to pay the deposits or interest on my deposits. Then yield a reasonable return. So at the end, whatever banking is providing these transactions or all kind of banking activities, bank also expects some kind of reasonable return. Now, every service that bank provides, it can be mobile banking, internet banking, or maintaining your savings account, or paying bills on behalf of you, paying your EMIs on behalf of the customer. For everything, bank is going to charge a fee. Yes or no? Bank is going to charge a fee. All this is going to form a reasonable return. So what are the causes of low profitability? We have heard that certain banks have high NPAs, that is non-performing asset. That means people have taken the loan or borrowed from the bank have not returned it back. That's called as non-performing asset. Example, the best example that we have in India is Vijay Mallya, correct? Now he has borrowed enough amount of crores from banks and has not returned back. So he is going to be termed as NPA in the books of banks accounts. So let's look at the causes of low profitability. Why does banks have low profit? Number one, granting loans at concessional rates. Granting loans at concessional rates. Now this is why to overcome this situation itself, RBI says keep a percentage of money with me, that is with the RBI, that is called as CRR. Keep a percentage, that is SLR, with yourself, but not in the form of liquid form, in the form of government bonds, government securities, etc. Keep it in terms of purchasing the assets or purchasing the securities. That way you have lesser amount of money at your disposal to give as credit. That way you will be careful about your profit margin. So there are so many banks who give out loans instantaneously, charging very low rate of interest. So if the source of income itself is very low, how will the bank earn profit? Not possible, correct? So therefore bank has to make sure, and granting loans, it takes precautions. Number two, undue branch expansion without consideration of cost and return. We can see that certain banks unnecessarily maybe start expanding or putting up branches in within a same locality. You might have 5 to 6 banks. Okay, same bank, you might have 5 to 6 branches. So that means it is an undue branch expansion without consideration. Now if there is transactions improvement, there are more people demanding, there are more customers that you need to handle, then you can open up a branch. But without there is a need for branch expansion and you're not looking into, it is not definitely not easy to set up a bank, right? Maybe it can be the instruction, it can be the entire infrastructure, the technology, the banking people, the lockers, labor, etc. It involves a lot of cost, right? Without thinking about the cost as well as the return, if I'm setting up a banking or a branch expansion in a particular locality, will I get enough return? Are people around this locality willing to open an account, willing to transact, willing to save their deposits? I need to think about all these aspects before I expand my banking branch. Number three, mounting overdues and raising bad debts. What is a bad debt? Now, all of you would have known, you're an account student, correct? Bad debts is when uh, all your debtors that you write under the current assets of balance sheet. That means those people who have to pay you the money, owe you the money, have not paid. Is that clear? Those who owe you the money have not paid the money. Those people are called as bad debts. Have you heard about doubtful debts? That's another case where you're doubtful about whether the person may pay back the money or may not pay back the money. So mounting overdues means people have taken the loan, have neither paid interest nor paid the principal amount. So that amount, even after repeated notices that you're sending to that person's post, right, to their home, you're sending a post that you're supposed to pay so and so amount by so and so date, etc. Even after repeated reminders, if the people or the persons do not turn up to pay, that is called as overdue. And what is it? Mounting. Mounting means what? Overdue for last year, let's say, was 1 lakh rupees for a bank. Now this year it has become 3,50,000. Now is that overdue decreasing or increasing? It is increasing. Basically it is mounting up. So these are the three major reasons why banks have low profitability, or banks are not able to run efficiently, because they give loans at concessional rates, they do unnecessary branch expansion without thinking about the cost and returns, and the increasing overdues and raising bad debts. The last topic, what are the recent developments to improve profitability? So we looked at what is profitability, what are the cause of low profitability, and let's look at the last point, how can the profitability be improved? So what are the developments recently made? Number one is managing asset portfolio in a more profitable way with a mix of new instruments. So I focus on not only giving loans to individuals, I also focus when I'm giving a loan, I need to do a thorough background check. Is that clear? I need to do a thorough background check. Or if the bank wants to invest money into buying securities, I cannot invest entire 1 crore rupees into or entire 10 lakh rupees into buying bonds or debentures. I need to segregate it. That's called as portfolio or asset portfolio. That entire 10 lakh I'm not going to buy into one investment avenue. What will I do? Maybe 2 lakh I will buy bond, another 5 lakh I'll buy government treasury bills, okay, another 3 lakh I may buy shares or securities, okay. So what am I doing? Entire lump sum amount, whatever deposit that I have, a part of it I will divide it among itself and invest into various investment avenues, which is called asset portfolio. So what is bank going to do? With a mix of new instruments. Now it can say mutual funds, or you can say venture capitalist, etc. Number two, making adequate provisions for loans in advance. All of you have come across the word transfer to general reserve, correct? Transfer to reserve. These words are what? Basically, I am if let's say I am giving a loan of rupees 5 lakh to a individual, or let's say even to a company. Now instead of waiting, let's say the tenure to repay the loan is 5 years. Amount is 5 lakh, and the time to return back is 5 years. So what do I do? Instead of waiting until the 5 years to observe whether he will repay it correctly, etc., or if he does not repay, what is the loss I have to incur? Instead of living in the future, I would rather make a reserve in his name. From my profits, a part of the amount I will pick it up and put it into general reserve. Is that clear? So tomorrow, in case maybe if he is paying back the entire principal amount and the interest, the bank is very happy. But then if the person defaults the payment, that means he does not pay the amount, at least I have a part of my capital as to face that loss. If he does not pay, it is a loss for the bank, correct? So how do I recoup that loss? How do I cover up that loss? Is by making enough amount of provisions or reserves for loans and advances given. Number three, enforcing prudential norms, income recognition, asset classification as per the standards. So since RBI has given certain standards and instructions, it's better for each of the commercial banks to abide by it, especially income recognition, asset classification. So I need to classify before giving a loan whether this person belongs to is his credit score better. Based on the credit score, I'm going to lend him the loan or lend him the credit, correct? So banks, in case one person defaults a loan, that information about that person or a company will be passed on to all the other fellow bankers. Why? Some other banks must not suffer the same loss. If today Mr. A has defrauded Canara Bank, for an example, that information that so and so person has defrauded, has not paid back, this information will be passed on to all the fellow bankers, so that other banks are careful not to issue any kind of further loans and advances to the same person or to the same company. Is that clear? So I need to recognize my income very carefully based on the background check. We also read about credit rating. If you remember about the financial services, we gave example about CRISIL and CARE. Even in the quiz I had asked about this question, if you remember. Now these are institutions who work upon credit rating of individuals, credit rating about companies, both. Is that clear? Both of them, they look at it. So these are the three basic recent developments that the banks have made for what? To improve the profitability. So today we looked at liquidity, concept of liquidity, 6 different factors that affect the liquidity, the profitability of the banks, what are the causes of low profitability, and the recent developments to improve